Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in.
Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Dan Seder. We have not been in this room recording all together for quite a while. I mean, we've released, we held a webinar and we've released other things, but it's been a while since we recorded. It's now late April. Anything happen between now and the last time we recorded?
Nothing in the markets.
Yeah, no, it's been pretty quiet.
Yeah, quiet. Yeah, I guess that explains why things have been so quiet around here. No, all jokes aside, we've tried to stay in front of everybody with communication via email and otherwise, but obviously a lot to discuss. And I think what we want to do today, just for the benefit of everyone listening and or watching, is just to hash out some of the things that we've been hearing and our take on everything that's transpired really over the last month and a half plus. And I will start by saying, when we started to see some of the volatility pick up, which really started happening at scale April 2nd, April 3rd, I was very clear within the investment committee where it's like, look, I don't think we need to make any changes until we start to become very confident in those changes. And I think that's really important to say just because a lot of the selling pressure that you see in the market really has been driven by knee-jerk reactions. Could they end up being correct? Sure, they could be in the short term. Now, what I would submit is that what we're kind of looking for right now and what we've been working through as an investment committee over the last 3+ weeks is trying to understand the knock-on impacts. We don't have any ability to see what some of the changes, some of the tariffs are what the impact is going to be economically because the data just hasn't come out yet. And when it does come out, shockingly, it's not going to have the full force of, for example, 3,000% tariff rate on China. So realistically, I think as a long-term investor, part of my job is to slow things down a little bit, right? Focus on the long term, focus on big, longer, secular kind of implications. And we've had very productive conversations in the investment committee over the last month. That doesn't always have to mean that we're making wholesale changes.
And it's tough as an investor because an investor will always look back with hindsight. Hindsight is 20/20. So we can look back to April 2nd and say, oh, geez, we should have run for the fences and been out of stocks. Not that that's representative of how we manage the portfolio, but hindsight for investors is always 20/20. In the moment, as quickly as this environment is changing, the moves that we've seen down, I think in April, the market at its worst, just in the month of April, was down north of or more than 13.5%. And we're almost back to even intra-month. So it goes to show you how quickly the environment can change. And it's really dangerous to jump lines at the grocery store. We use the price check analogy where you say, oh, that's a shorter line, I'm going to jump there, and then all of a sudden that line gets held up. And that happens to investors. So investors need to be patient because of the pace at which this environment is changing.
Right, and I think like even more so today than we've seen in past occurrences, because I don't think I've ever seen a situation like we have right now where quite literally, because all of the selling pressure pretty much has been predicated on the tariff situation, because you have one person that can change what the tariff situation looks like with the snap of a fingers, like we saw 2.5 weeks ago, Wednesday, I can't even remember the exact date, but when the S&P 500 shot up 10% after 1 p.m., it just, there are very few times I can recall that this unhinged volatility can be completely depressurized in an instant.
And not to make this a political discussion, but Donald Trump views the stock and the bond market as a barometer of success. And so I think when you just look at it in terms of stocks, I think bonds are more the stability of the overall macro environment. But when it comes to stocks, that is one barometer that is being watched, just like the Fed's watching it, stability in overall markets. And so these things matter. The stock market matters, and I think the rhetoric can adjust accordingly, whether that's the political environment moving stocks, or maybe it's the other way around, stocks moving the political environment.
Yeah.
Which is an interesting way to think about it.
You know, the other thing too, like the recipe for the extra volatility that we had. I mean, we really came into this April 2nd, you know, with overbought technology stocks. I mean, they weren't necessarily technically overbought. The NASDAQ, you know, as a composite was struggling to get through 20,000, which is a key kind of resistance level. It had been failing that going back to the early winter. And, you know, these stocks are all priced for perfection. We had talked about this a lot, right? I mean, NVIDIA, you know, everybody has FOMO with NVIDIA. That's the classic stock to think of in this case. And NVIDIA was priced as if they were going to have nearly a near monopoly on the AI chip market in perpetuity. That was the only way to justify NVIDIA's valuation. And when you have stocks that are priced for perfection like that, it doesn't take much to knock them off their pedestal. And the fall can be quite steep.
Yeah. Yeah, and so
it was.
I think one of the most common questions that a retail investor will ask right now is, okay, like, do I buy the dip, right? Like, are things on sale? And it does depend how you think about it. And what I would say, maybe like a more like devil's advocate approach, is that whether or not you should be buying the dip is very company specific at this juncture, because what hasn't really happened yet is that earnings estimates for S&P 500 companies have not been taken down yet at scale as a reflection of the broader tariff equation. So if you did see an environment where, let's say, this tariff exemption for that 90-day period doesn't happen, tariffs go into full force, all of a sudden you could say, I mean, S&P 500 companies, by and large, as a collective, are overvalued. Now, that doesn't mean that you haven't been able to find pockets of dislocation. I would say quality businesses, specifically those that are generally less globally intertwined, those have held up better, and they, in a situation like I just outlined, probably will hold up better. So I do think that right now I am just maybe a little bit more cautious on the dip buying mentality, at least on some select subsets of the market. Because, again, I'll take it back to what I said at the onset. Like, we just don't know what actually is going to shake out of all of this.
Yeah, and I think that's probably fair in the current environment that we're in. When I think over history, the history of the stock market as we know it today, and we always talk about these three pathways that investors can take. The first pathway is if they need cash, and they're nervous, they produce 18 months of cash into a money market account and let the remaining portion of their portfolio hold its allocation, right? So if you're super nervous, hold cash in a dollar amount enough to cover your cash flow needs over the next 18 months. If you're nervous but you don't need cash, maybe you dial back your allocation. So if you're 80% stocks, 20% bonds, and you can't sleep at night, you go from 80-20 to 60-40 or some more conservative mix. And the third type of investor is one that doesn't like this environment because it makes them uncomfortable, but they do nothing. They stay patient, they stay disciplined. But as you're talking about, do I buy the dips? I actually think there's a fourth type of investor, one that's let's say 70-30 stocks to bonds, that then shifts some of the bonds over to stocks today. That makes that move from something more conservative like a bond or cash into stocks. Because a lot of people are going to say, well, geez, I wish I had cash to buy. I don't have cash. I'm fully allocated. Well, you can adjust that allocation. And maybe it's blind faith in the history of stocks that I have when I make this stance. But I think that over time, when you look at the outcome for investors using those four scenarios, that the best outcome comes to the person who's actually getting more aggressive during an environment like this, and compared to the one that does nothing, compared to the one that maybe changes their allocation, compared to the one that goes to cash in some way, shape, or form. So my blind faith in the the movement of stocks over time is one that those who do buy the dip over time will end up with the best outcome, even if that outcome temporarily gets worse, because we don't know where the bottom is, if we've reached a bottom or if we're anywhere near a bottom. So things could certainly get worse before they get better. But when I look out 5 or 10 years, if that is the time frame that you're dealing with, my gut says that those who are buying dips, and as long as they're doing it not as a one-time move, not as a one-time event, but they do it with some systematic, consistent nature, that over time they end up benefiting.
Yeah, and actually it brings up a good point. Like, because of how choppy and just how like quick twitch the market is, I mean, I think this is a very individualized conversation, totally. Which is kind of like,
yeah, it is.
It's what you're saying, like, without saying it precisely. Because, I mean, right, wrong, or indifferent, if you're a person that, you know, is generally uneasy and nervous in this type of environment, and you get bullied into, I don't know, upping your equity allocation on a strategic basis by 10%, and it causes you to have a stroke, like, you know, that's not like what we're, you know what I mean, arguing for. This is very individualized. Like, this is very much dependent on individualized risk tolerances, return preferences, income requirements, all of that sort of stuff. But I absolutely do agree with you. I mean, if you zoom out and look at a 10-year period, I mean, you know, it's going to be really challenging for me to argue against at the equity market.
I agree. It's individualized. But what's important is financial advisors need to listen to their clients during a period like this, because a nervous investor. So let me just preface what I'm going to say with this. And we say it internally all the time. Our job is to make recommendations. Our clients ultimately make decisions with their money. And so if a client comes to us really, really nervous, and we're asking them to get more aggressive or to stay the course, and the stock market drops for the next 3 to 6 months, that is an eternity. And that person is then at risk of saying, darn it, I wanted to make a change before you talked me out of it, Dan. And then they throw in the towel and they capitulate right at the wrong time before the market actually zooms higher. So it is an individualized conversation, but I want to stress that financial advisors have to listen to their clients, because this is not what do we say versus what a client does. This is a partnership between us and our clients, helping them manage their money and their wealth in a way that works for them. It's got to work for them. And if we're putting someone at risk of maybe getting more aggressive than they feel comfortable getting, and the markets temporarily move lower, that really exposes the client to saying, I thought I had it right the first time, and now I'm wrong. I'm done, and they throw in the towel. So that's important.
Well, and it's like, it just goes back to, like, in a period like this, in a client conversation, it almost matters less about exactly what you say. It matters more that you're saying something to them and you're having a dialogue. I think that's part of the reason why, like, our advisors, I mean, from the outside looking in, have tried to be very, very, I would say, in front of the curveball, right? And trying to make sure there's a dialogue that's ongoing. And even though, again, like, we haven't made any investment decisions at scale, there certainly have been individualized decisions to rebalance certain things or stockpile extra cash just because there's a forthcoming large purchase, whatever. But I think that even in this type of scenario where we don't have a crystal ball and we don't know what the economy is going to look like in 6 months, I think having that conversation and listening are more important than anything else we could be doing right now.
So like, let's have some fun here for a second, because I was on vacation. I was listening to a group of people somewhat within earshot of me. They're talking about the markets. And the one gentleman asked the other gentleman, he said, so what are you doing with the markets? He said, I'm shorting the markets. The other guy fires back very quickly. He goes, you're shorting the markets? He goes, we're setting higher lows. And it kind of got me to go back to technical analysis in a time where fundamentals are unknown, not even uncertain. They're unknown. Yeah. What is the market telling us? How is the market digesting all this information? And how is that reading through to the stock price, stock patterns, the S&P 500? And I thought that was a great point. At the end of the day, we're setting higher lows, we're setting higher highs. In the short term, 5,500 on the S&P is going to probably be a difficult level to get through.
Yeah.
And then the 200-day moving average will come. But if the market starts to get through those levels, you do have to shift your mindset a little bit and say, okay, I need to maybe be a little more comfortable being bullish, because that's when you run the risk of the market running away from you,
Mm-hmm.
you go regretting not buying a dip or not doing something. And then you're sitting there waiting, well, if the market pulls back, and when those start to get blown through as far as the price heading north of 5,500, the 200-day moving average, what else is going on in the markets that people don't think about is people are covering shorts. You have short squeezes. People are no longer short the market, and you can start to stack a lot of days consecutively, and the market can run. And that's one big reason I think collectively we're not taking a ton of dramatic action, because the economy yet has not dictated that we should.
Mm-hmm.
So the economic data is still strong enough. Housing's strong. You're going to probably have a bump in auto sales due to people wanting to rush in before tariffs. Yeah. So you got to really take it all. And at the end of the day, in these times, I think looking at the market charts is really interesting.
Yeah, I think it matters how you get through key levels or go back and test key levels. So if we test prior lows, how is the market testing those? Is it because of a change in rhetoric on tariffs? Or is it because of healthy underlying market metrics like the breadth of the market or sentiment? I think the markets can reach key levels in different ways, and you'd want it to be a healthy manner in which you're breaking through key levels, which is important. But I want to throw this out there, and maybe something for us to talk about for a second. We're saying so much is unknown. True. The markets are always uncertain, and no one has the crystal ball, so we don't know what the future has in store. But what do we know? We know VIX, which is the measurement for volatility in the stock market, gives us a reading of what to expect day by day in the stock market. And so I'm going to translate VIX, which is predicated on the S&P 500, into a Dow metric, because the Dow is the people's index, and I feel like that's what we all talk about at the pool, or at a party. Somebody's going to say, "Hey, what was the Dow up today?" They very rarely talk about the S&P 500, but the VIX right now at a measurement of north of 25 would imply that the Dow Jones should be moving day by day, whether that's up or down, roughly 650 points. It's pretty wild when you think about the days of a lower price Dow, and somebody would say, oh, the Dow's up 100 or 200 today, and that felt like a real move. And now what we can and should expect day by day, whether it's up or down at current VIX readings, is a move of 650 points in the Dow, and that would be nothing but normal.
Yeah.
Absolutely normal. And so as an investor, even though you don't have the crystal ball, what you should expect is volatility. How much volatility? On a day-by-day basis, 650 Dow points at current VIX levels. And I think what that means is buckle up. It's like getting on a plane. There's going to be some turbulence. You're not going to grab a parachute and jump out the back if the pilot says we're going to experience some turbulence. You buckle up or tighten up your.
And I'm always fascinated though with this concept of like the VIX. And one thing, it's like this marketism that I've always found really interesting is, what do periods of low volatility tell us that volatility is going to be coming? As people get complacent.
Yeah.
And likewise, the opposite's true. What happens during periods of high volatility? Well, low volatility is coming.
Mm-hmm. Yeah.
So
it's not going to stay at this level forever.
Yeah, these are just things that the market's going to work through. You'll have a ton of this environment where things are volatile. Then you'll have a long period of complacency, and then short bursts of volatility, long periods of complacency.
Yeah.
And I think investors just need to remind themselves of that. Like you said earlier, volatility is the price you pay for return.
Yeah.
It's meant to be uncomfortable. If it wasn't, everybody would do it. This would be no problem. Nobody have $1 parked in a bank account. if there's no
Yeah.
volatility. You'd have zero savings.
Let's talk about that. Let's just break that down because I think it's important to call out. If you risk money in the capital markets, whether that's stocks or bonds, your expectation is that you're going to earn some type of return
Over time.
And that return should compensate you for an increased cost of living, inflation. You should earn inflation-adjusted returns on your capital that you've risked. So again, this balancing act of risk and return, we're all familiar with it. But to your point, the price that investors pay for a return is volatility. And that is an expectation that you should fully embrace when you drive past the bank and you pull into our parking lot. When we're taking risk of some nature, it's not you get reward with a free lunch. It's not a free lunch. You do have to pay something, and what you pay is volatility, and that is when human emotions get involved, and it makes it difficult because we get uncomfortable when times like this arise, and it's not the most warming feeling, but it's one that reminds us you got to stay disciplined. That volatility is normal, and if you stay in the game over time, our expectation is that you're going to end up with a good, a nice outcome.
Yeah, and like the long-term average statistics that you see, those are not indicative of lane changing at the grocery store, right? To your point, like volatility is the price you pay to generate those returns. I mean, we've all seen them, high single digits, sometimes low double digits, depending on the specific time period you look at.
Yep. Yeah. What else? Anything else?
No, I would say we're trying right now to keep folks informed, both via written communication, video conversations like this, and you can expect that to continue, especially as market developments have been so rapid. So you can expect that to continue. We will continue to provide what we view as hopefully thoughtful dialogue on any changes, how we're digesting them, how we're thinking about them, what we do envision in terms of knock-on impacts as they become more clear.
Quick shout out to the investment department. You guys have done a great job of communicating with clients in terms of email communication. I know we're trying to do more of these podcasts and video recordings, and so we want to keep producing original content that keeps our clients and the prospective clients informed on what we're seeing and what we'd expect in the markets.
Yeah, well, thanks. Certainly, there's been no shortage of opportunities to do that over the last month and a half. So, but thank you. We're trying to keep people informed. So, with that, I think I'll leave it for the day. Thanks as always for tuning in. Another episode of Blue Chip Now. We look forward to speaking with you again soon.